Cloudfare is an $80 billion cloud security and performance company that has seen its shares rip 33% higher in just the past 2.5 weeks since the war in Iran began. The reason is that the market now expects more cyber attacks going forwards and anticipates greater demand for services of Cloudfare. In today's video, I will show you the most aggressive hedged stock investment strategy for shares of Cloudfare that I consider for new client accounts. Now, this is the most aggressive strategy I will consider because I actually think shares of Cloudfare will be volatile and have some chop associated with them over the next couple of years. With that said, and this is not investment advice, the strategy consists of buying 100 shares of Cloudfare, ticker NET, at $225 a share, and going into the options market expiring January 21st, 2028, which is 22 months in the future, and selling a call option at a strike price of $230 a share. This strategy is a long-term at-the-money covered call. What does this mean? This means that come option expiration in 22 months, if shares of Cloudfare, $225, are at or above the contractual strike price of $230 a share, that the strategy will see the shares called away or sold at $230 a share, irrespective of how much higher shares may be trading at that time. Why would you limit your maximum upside potential to just 2%? The reason is because you receive hedged income equal to $75 a share. $75 a share in hedged income divided by a purchase price of $225 a share is hedged income of 33%. This is your guaranteed income to keep so long as you maintain this position until hedge expiration in 22 months. If shares of Cloudfare at that time are trading at or above $230 a share, then the maximum return for the strategy is the sum of the 33% hedged income plus the 2% capital appreciation potential. If shares are unchanged, then the strategy return is the hedged income of 33%. If shares fall, then the hedged income of $75 a share serves as a buffer of downside protection, meaning that the break-even price for shares is the difference between the shares purchased at $225 and the hedged income received of $75 for $150 a share. At option expiration, there are diminishing profits between $225 and $150 a share. At $150 a share, the strategy breaks even, and below $150 a share, there is loss exposure. As you can see, this is a strategy intended to optimize a balance between total return potential and downside protection.